In this module, we are analyzing cost behavior. It's so very important for a manager to understand what the costs would be at different levels of activity, especially if they are planning to increase sales or increase production. Some costs will increase and some will not. Knowing which costs will increase and which will not helps a manager predict what would happen in the future. So we're going to learn about a variable cost, fixed cost, and mixed costs. Now we can't deal with a mixed cost, so we have to break it into its variable portion and its fixed portion. And we do that with a high-low method. Now we look at the statement of operations, the income statement, which has been presented following generally accepted accounting principles. However, that is not very useful to us as managers. So we rearrange the income statement into those costs that are variable and those costs that are fixed. And we introduce now a new line in the statement called the contribution margin. Understanding the contribution margin is of great value to planning future activities. This module is on cost behavior, and we introduce now the contribution margin. In this module, we're going to analyze cost and distinguish between those costs that are fixed costs and those costs that are variable. We also have mixed costs. Now, a mixed cost is partly fixed and partly variable. And we will learn a way in which we will break the mixed cost into a fixed portion and into a variable portion. Then lastly, we look at a cost volume profit income statement, and we introduce now a contribution margin. Cost behavior analysis is the study of how costs respond to changes in the level of business activity. Now, when we're talking about business activity, we are basically talking about sales or production. Now, some costs will change as business activity changes. Other costs will remain the same. Knowing which ones will change and which ones will remain the same helps management plan operations and decide between alternative courses of action. Now, this cost behavior analysis applies to all types of businesses and business entities: sole proprietor, partnership, corporation, service company, merchandise company, manufacturer, and nonprofit. Now, the starting point here is measuring business activity. So when we talk about that, we're talking about activity levels. We could be talking sales dollars, for example. And most often in this module, that's what we will be talking about. And we could be talking about miles driven. Okay, we could be talking about room occupancy. We could be talking about the activity of offering dance classes, whatever the activity. There are costs attached to these activity, and our job now is to distinguish between those costs that change as the activity level increases or decreases and those that do not. Now, we're going to make some assumptions. Changes in the level or volume of activity should be correlated with changes in costs. Okay, activity index is when we talk about the level of volume of activity we're talking about. The activity index identifies the activity that causes the changes in the behavior of costs. Okay, it allows us to classify the cost into variable, fixed, and mixed. Now, a variable cost is a cost that changes in total. The key word is in total, in direct proportion with changes in the level of activity. If the activity increases 10%, then the total cost, if it increased 10%, will be a variable cost. If the activity level decreases, then a variable cost will decrease by the same percentage. And that's the definition of a variable cost. It changes in total in direct proportion to changes in the level of activity. I'm talking in total. Now, if I look at a variable cost on a unit basis, then a variable cost will remain the same per unit at every level of activity. Let me give you an example. Let's assume I'm manufacturing this desk that I'm sitting at here. Now, obviously there's wood that went into the production of the desk. So I want to look at the cost of wood. And I analyze it, and the cost is 50 for a desk. So if I produce one desk, the total cost is 50. If I produce two desks, the total cost would be 100. If I produce 10 desks, the total cost would be 500 for wood. Therefore, I would say wood is a variable cost because it increased in direct proportion. When I doubled the volume from 1 to 2, the cost for wood doubled in total. When I went 10 times the volume, then the cost of wood increased 10 times. So it's a variable cost because it changes in total. But you will notice if I look at the unit cost of wood per desk, it remains the same. If I produce one desk, the unit cost is 50. If I produce two desks, the unit cost is 50. If I produce 10 desks, the unit cost for wood is 50. So that's how a variable cost behaves in terms of activity. Now, here's another example. Damon Company manufactures tablet computers that contain a $10 camera. The activity index is the number of tablets they produce. As Damon produces each tablet, the total cost of the camera increases by $10. All right. Therefore, if Damon produces 2,000 tablets, the cost would be 20,000 and 100,000 if they produce 10,000 tablets. So you can see from the graph, at zero activity, zero costs. But as the activity increases, the cost increases proportionally. However, if I'm talking about a variable cost per unit, then the $10 camera for each tablet produced remains the same unit cost. That is, it does not change on a unit basis with changes in the level of activity. So therefore, if I'm looking at graphs, on the left, you see that if I'm talking total variable costs, the graph is proportional. If I am talking variable cost per unit, it's constant at 10. Now contrast that with a fixed cost. The fixed cost remains the same regardless of the changes in the activity level. So again, let's assume I'm manufacturing this desk in a plant, and the plant costs me $20,000 a month. If I produce one desk, the cost for rent is $20,000. If I produce two desks, the cost for rent is $20,000. If I produce 100 desks, the cost for rent is $20,000. It does not change with the level of activity. However, if I look at a unit basis and I say, okay, what's the unit cost for rent? If I produce one unit, the unit cost for wood is $20,000. Okay. If I produce two units, then the unit cost for wood now is $10,000. If I produce 200 units, then the unit cost for rent would be 100. Sorry. So you see a fixed cost decreases as on a per unit basis, it decreases as the activity increases. Examples: property tax, insurance, rent, the one I just did, and depreciation. So therefore, if you were to draft that, you would have a straight line. And here we have Damon Company leases its production facilities at a cost of $10,000 per month. Total fixed costs of facilities remain constant regardless of the level of production. However, on a unit basis, the unit fixed cost decreases as I increase production. And that is the nature of a fixed cost as compared to a variable cost. And when we graph it, this is how it would look. Now, we have to bring in the idea of what is called relevant range. When I said that I'm producing a desk in a factory that I'm paying $20,000 for on a monthly basis, then the fixed cost would remain the same for whatever level of activity. However, when I reach the capacity of that building, then let's assume the capacity is 1,000 desks. Well, if I want to produce more, I can't without adding a lot more fixed costs. So between 0 and 1,000, I can say that rent is a fixed cost within that range of level of activity. But once I go outside that range, the step cost, the fixed cost increases in steps. It does not increase proportionally. So between 0 and 1,000, when I'm talking about cost behavior, that's the relevant range of the fixed cost. And I assume now that when I'm analyzing costs, I am within that relevant range. But as you can see on the right, the cost will remain fixed until a certain point, and then it jumps. It's called a step cost, and it will increase in chunks once I am outside the relevant range. Now there's a third category, and that third category of costs are mixed costs. A mixed cost is partly fixed and partly variable. Well, you can understand that electricity would be a variable cost. The more I have the lights on and running the machines, the more the cost would be in total. However, if I turned everything off and I'm not running anything, there is still a cost for electricity. So you see, electricity is partly fixed, partly variable. Same with telephones. Of course, the more calls you make, the more the telephone costs would go up. However, if you don't make any, you still have a portion of fixed costs that you have to pay. So some costs are partly fixed and partly variable. And as an example here, you can see up to 50 is fixed, and then the rest of the costs is variable. So the total cost line is partly fixed and partly variable. All right, so now we have to identify a mixed cost. A mixed cost is one that will change as the level of activity increases or decreases, but it will not change proportionally with changes in the level of activity. A variable cost does change proportionally. So when you look at the data we have here, you're asked to identify the variable cost, the fixed cost, and the mixed. Well, you can see I have production at 10,000 units and production at 20,000. The first cost, direct material, is 20,000 when I produce 10,000 units. And when I double the amount of units I produce to 20,000, the cost doubles from 20 to 40. So obviously, direct material is a variable cost. It changes in total in direct proportion to changes in the level of the activity. Maintenance at 10,000 is $8,000. And when I double the output or I double the production to 20,000, the maintenance cost changes, but it doesn't change proportionally, all right, with the level of activity. It does not double when production doubles. It moves from 8,000 to 10,000. Direct labor, it doubles, so it's variable. Indirect material, it doubles, so it's variable. Depreciation at 10,000 units is 4,000, and it's 4,000 at 20. It's a fixed cost. Utilities is 3 at 10,000, but it doesn't double, it only goes to 5. So it's mostly variable, but partially fixed. And rent is fixed. So there are your variable costs, there are your fixed costs and your utility costs. Now, we can't work with a mixed cost. We have to break it into its fixed portion and its variable portion. Now, we know the variable portion changes with level of activity, but the fixed doesn't. So what we do then is we track this cost. We plot it actually for a 6-month period. And then we take the high level of activity and the low level of activity. And we take the costs at the high level and the costs at the low. Now that difference represents the variable cost. For example, we have here the variable cost per unit is the change in total cost divided by the change in the activity. All right. Metro Transit Company has the following maintenance costs and mileage data for a fleet of buses. And there you see that as the activity increases from 20 to 40, but the total cost does not double. So it's a mixed cost. So what we do then is we take the high activity, and that is April at 50,000, and we take the low activity, and that is January, sorry, at 20,000. So we take the change in the change in costs at the high, 63,000, at the low, 30. We take the change in costs, 33,000, over the change in the level of activity. We get $1.10. The cost changes $1.10 per unit of activity for every mile driven. Okay. All right, that's the variable portion. What about the fixed? Well, now for the fixed, we go back to the high level and we say, okay, the cost at the high level was 63,000. At the high level, we traveled 50,000 miles. So therefore, the variable portion of that 63,000 would be 50,000 times $1.10, or 58,000. The difference would be the fixed cost, in this case, 8,000. And if it's fixed at the high, it's also fixed at the low. So take the low total cost meaning fixed and variable, was 30,000. The variable portion was that we did an activity of 20,000 times $1.10. So the variable portion of the 30,000 is 22, and the difference is 8,000. And so we break it into the fixed and the variable. So maintenance costs, therefore, 8,000 per month plus $1.10 per mile. All right, so we can estimate the maintenance costs. It's equal to 8,000 plus $1.10 for every mile driven. For example, at 45,000 miles, I could estimate that the cost would roughly be 8,000 for the fix, 49,500 for the variable, and the total cost would be 57,500. What's important here, though, is the maintenance cost has been broken into its fixed and variable portion. And what we want to do is look at all the costs involved in the business and determine which costs are fixed and which costs are variable. So now we know what the, if we were to graph it, there's the high-low. We take the high activity and the low, and it's a linear line. Y equals A plus BX. And we take the line back to where it intersects with the axis. And that, of course, would be the fixed portion. Now that we have analyzed in the company all the costs the product costs and the period costs. That is the direct material, the direct labor, the manufacturing overhead, that portion of the manufacturing overhead that is fixed, that portion that is variable. And we take a look at the period costs, selling and admin costs, and we break them into the fixed portion and the variable portion. Now we go back to our statement of operations. Here is Vargo income statement for the year ended. Sales, 1,600 units, 800,000. Cost of goods sold, 520. Gross profit, 280. Operating expenses, 160. Net profit, 120. Now this income statement is prepared according to generally accepted accounting principles. It's designed to communicate operations to people outside the business so they know how well we're doing. But we are managers. We're inside the business. And the way this income statement is formatted is not very useful to us. Now that we know that there are fixed cost of goods sold expenses and there are variable cost of goods sold expenses, and the same with selling and admin, we reorganize the statement. That is, we look at the variable expenses, the cost of goods sold, the variable selling, and the variable administration. We totaled them up. They're 480. Now, because they're a variable expense, they're going to change in total in direct proportion with changes in the level of activity. The fixed cost will not. The fixed expense, cost of goods sold, portion of cost of goods sold that is fixed is 120. Portion of selling expenses that is fixed is 40, and admin is 40. So the total fixed is 200. So now I'm looking at my financial statement. I say, okay, sales 800, variable costs 480, and fixed costs 200. I subtract my costs and I have net income, 120,000. I haven't changed anything. I just rearranged the costs in terms of those costs that are variable and those costs that are fixed. Now, because the variable cost of 480 will increase in direct proportion to sales. If I increase sales by 10%, then the total variable costs will increase by 10%. So if I increase sales by 10% would be 80,000. Well, the total variable cost would go up 48,000. So you see the variable costs will always move in total with changes in the sales. So we can net those two together. That is, we can subtract the variable cost from the sales. And we get 320. We call that now the contribution margin. Now, this is only for management purposes. This is not for people outside the business. This is not gross margin or profit margin. This is contribution margin. Contribution to what? Contribution to fixed costs. So I have a total contribution margin of 320. I have fixed costs of 200. So when I cover the fixed costs, I have 120,000 left. That is my profit. So you see the contribution margin contributes to cover the fixed. Once it covers the fixed, it then is net profit. So now you have a new term, contribution margin. It's a very important, useful tool in predicting cost behavior in the future. And the total contribution margin is 320. Now we could look at this contribution margin on a unit basis. That is, we sold 1,600 units. So the per unit cost for this product was 500. Therefore, the variable portion is 300, 480,000 divided by 1,600 units. I get 300. And now I have the contribution margin per unit. So now you see every unit I sell, in comes 500 in sales, but I use 300 to cover the variable costs. I have 200 left over to contribute to fixed costs. And that's the way we look at it. Now, how many units do I have to sell to cover the fixed costs? That's what we're going to talk about in the next module. We're going to continue here with the new terminology: contribution margin in total, 320. Contribution margin per unit, 200. All right, now we're asked to look at Vargo produces a high definition digital camera, and the relevant data is as follows. The selling price, 500, variable cost, 300, fixed costs, 200,000, and units sold, 1,600. So there again is my statement. Now, contribution margin per unit is the difference between the unit selling price and the unit variable cost. If I looked at my statement and I say, how many units do I have to sell? I earn a contribution margin of 200 per unit to cover 200,000 in fixed costs. Well, obviously, dividing 200 into 200,000 gives me what we call our break even. Okay. Now, the next unit we sell beyond break even, the 200 contribution margin per unit is no longer needed to cover my fixed costs. My costs are covered. Therefore, that 200 becomes profit. Now, another definition, contribution margin ratio. This is also very useful to us in terms of management. Now, when you hear the word ratio in management, it always means a percentage of sales or a percentage of selling price. Depends if I'm talking unit or total. All right, so contribution margin ratio is the contribution margin divided by sales, or it's the contribution margin per unit divided by the unit selling price. In both cases, it would be 40%. And that is the contribution margin ratio. Now, when we look at our income statement again, or our statement of operations, we look at sales. Now, sales is always 100%. And the contribution margin is 40% of sales. Therefore, the variable costs are 60%, the complement. And that holds true for the contribution margin per unit as well as the contribution margin in total. So there you are now responsible for three new concepts: contribution margin in total, contribution margin per unit, and the contribution margin ratio. In the next module, then, we will continue this by determining, as you've already seen, the break even, then the target of net income, and then the margin of safety. Now that you understand how costs behave, and you are able to rearrange the income statement into a cost volume profit margin income statement, and you're familiar with the contribution margin, we now move to the next module,